Hello friends, Rahul Jha welcomes you. Today we will talk on topic what does investing in share means. Let's start. Investing in shares, also known as stocks or equities, means buying ownership in a company. When you invest in shares, you become a shareholder, which entitles you to portion of company's assets and earnings. Here are the key concepts associated with investing in shares. Ownership. When you buy shares of a company, you become a partial owner of that company. The number of shares you own determines your own ownership stake. Dividends. Some companies distribute a portion of their profit to shareholders in the form of dividends. Dividends can provide a steady income stream for investors. Capital gains. Investors can profit by selling these shares at higher price than the purchase price. The difference between selling price and the purchase price is called capital gains. Risks. Share price can be volatile and the value of your investment can go up or down based on various factors, including market conditions, economic trends, and company performance. Market exchanges. Shares are bought and sold on stock exchanges such as the NSE or BSE. Investors typically use brokers to facilitate these transactions. Long-term growth. Many investors choose to invest in shares with the expectation of long-term growth over time. The value of well-performing companies may increase, providing a positive returns on investment. Research. Successful investing often requires research and analysis of companies and market trends. Investors may consider financial reports, company news, and economic indicators to make informed decisions. Diversification. Spreading investment across different companies and industries help manage risks. Diversification can reduce the impact of poor performance of one investment on the overall portfolio. Liquidity. Shares are generally considered liquid investment because they can easily be bought or sold on the stock market. This liquidity allows investors to convert their holdings into cash relatively quickly. Types of shares. There are different types of shares, including common shares and preferred shares, each with its own set of rights and characteristics. It is important to note that investing in shares carries risks and there are no guarantees of profit. Before investing, individuals should assess their risk tolerance, financial goals, and conduct thorough research or consult with a financial advisor. Why investment in shares considered dangerous? Investing in shares is considered risky for several reasons. Volatility. Stock prices can be highly volatile and they can fluctuate significantly over short periods. This volatility can be influenced by various factors including economic conditions, geopolitical events, and market sentiments. Sudden price changes can lead to substantial gains, but they can also result in significant losses. Market uncertainties. The stock market is influenced by a wide range of factors and predicting its movement accurately is challenging. Economic downturns, political instability, and unexpected events can contribute to market uncertainty, making it difficult to foresee and mitigate potential risks. Company specific risks. The performance of individual companies can be affected by factors such as management decision, competitive pressures, changes in industry trends, and regulatory developments. It is a company if a company faces financial difficulties or fails, shareholders may experience a loss. Lack of control. Shareholders typically have limited control over the management and decision making processes of the companies in which they invest. Corporate decisions such as mergers, acquisitions, and changes in strategy can impact shareholders' value without their direct input. Leverage and margin trading. Some investors use leverage, borrowed money, or engage in margin trading to amplify their investment positions. While this can magnify gains, it also increases the potential for significant losses as losses may extend or exceed the initial investment. Psychological factors. Investor behavior and emotions can play a significant role in stock market movements. Fear and greed can drive investors to make impulsive decisions, such as panic selling during market downturns or chasing high risk investments during bullish periods. Lack of diversification. Failing to diversify a portfolio by investing in a variety of assets and industries can expose investors to concentrated risks. If a particular sector or asset class experiences a downturn, an undiversified portfolio may suffer more severe losses. Lack of information. Investors may not always have access to complete or accurate information about companies or market conditions. Inaccurate or incomplete information can lead to poor investment decisions. Short term market fluctuations. Investors with a short term focus may be more susceptible to market noise and short term price movements, which can be influenced by factors unrelated to company long term fundamentals. Regulatory changes. Changes in regulations, tax policies, or other government interventions can impact the profitability and outlook of companies, affecting share prices. Despite these risks, it is important to note that investing in shares also offers the potential for significant return over the long term. Risks can be managed through careful research, diversification, a long term investment horizon, and a thorough understanding of one's risk tolerance. Many investors find success in stock market by adopting a well thought out investment strategies and staying informed about market conditions. Additionally, seeking advice from financial professionals can help investors make more informed decisions. Why 99% of people lost their money investing in stock market? The assertion that 99% of people lost money in the stock market is a broad and somewhat exaggerated statement. However, it is true that significant number of individual investors may face challenges and experience losses. When investing in stock market, here are some reasons why some individuals may struggle or incur losses. Lack of knowledge and education. Many people enter the stock market without a sufficient understanding of how it works, the risks involved, and the strategies for successful investing. Lack of financial literacy can lead to poor decision making. Emotional decision making. Investing often involves dealing with emotions such as fears, greed, and panic. Emotional reactions can lead to impulsive decisions such as selling during market downturns or buying into hype driven investments. Short term focus. Investors seek quick profits, may engage in social term trading, attempting to time the market. Short term trading can be challenging and it is often influenced by unpredictable market fluctuations. Chasing performance. Some investors may be tempted to invest in assets that have recently performed well, expecting the trend to continue. However, past performance does not guarantee future success, and chasing hot investment can lead to buying an inflated price. Lack of diversification. Failing to diversify a portfolio can expose investors to concentrated risks. Overemphasis on particular sector or asset class can result in significant losses if that sector faces a downturn. Overconfidence. Overconfident investors may believe that they can consistently beat the market or predict short-term price movements. This can lead to excessive trading, higher transactional cost, and increased exposure to market volatility. Leverage and margin trading. Using borrowed money, leverage to amplify investment, or engaging in margin trading can lead to substantial losses. Leverage magnifies both gains and losses, and market downturn can result in margin call, forcing the investor to sell at a loss. Inadequate research. Failing to conduct thorough research on companies and market conditions can lead to uninformed investment decisions. Lack of due diligence may result in investments in companies with weak fundamentals. Market timing. Trying to time the market by predicting when to buy or sell stock can be challenging. Market timing often involves making decisions based on short-term market trends, which can be unpredictable. Ignoring risk tolerance. Investors who do not assess their understand their risk tolerance may take on more risks than they can handle. This can lead to panic selling during market downturns or holding onto losing positions for too long. It is important to note that successful investing requires discipline, a long-term perspective, and commitment to ongoing education. Diversification, risk management, and well-thought investment strategy are crucial elements for navigating the complexities of stock markets. Seeking advice from financial professionals and continuously learning about investing can help individuals make more informed decisions and potentially improve their investment outcomes. How can they start making profit and make money in stock market? Making a profit and succeeding in the stock market requires a thoughtful and disciplined approach. Here are some strategies and tips for individuals looking to start making money in the stock market. Educate yourself. Take the time to understand the basics of investing, including how the stock market works, different investment vehicles, and various investment strategies. Stay informed about financial news, economic indicators, and market trends. Set clear financial goals. Define your financial goals, whether they are short term or long term. This will help guide your investment decisions. Create a budget. Establish a budget to determine how much money you can comfortably allocate to investments. Avoid investing money you cannot afford to lose. Diversify your portfolio. Diversification involves spreading your investment across different asset classes, industries, and geographic regions. This helps mitigate risks and improve the overall stability of your portfolio. Invest for long term. Adopting a long term perspective, successful investing often involves patience and the ability to weather short term market fluctuations. Avoid emotional decision making. Emotional reaction can lead to poor investment decisions. Stick to your investment plan and avoid making impulse moves based on fear and greed. Conduct through research. Before investing in a company, conduct thorough research on its financial health, management team, industry position, and growth prospects. Use financial statements, earning reports, and other relevant information. Stay disciplined. Develop a disciplined approach to investing. This includes adhering to your investment strategy, rebalancing your portfolio periodically, and avoiding a market timing attempts. Understand risk tolerance. Assess your risk tolerance to ensure your investment strategy aligns with your ability to handle market fluctuations. A well-considered risk management plan is crucial. Consider dividend stocks. Dividend-paying stocks can provide a steady income stream, making them attractive for long-term investors. Reinvesting dividends can also boost return over time. Utilize rupee cost averaging. Invest a fixed amount of money at regular intervals, monthly, regardless of market conditions. This strategy can help reduce the impact of market volatility. Seek professional advice. Consider consulting with a financial advisor to get personalized guidance based on your financial situation, goals, and risk tolerance. Stay informed about taxes. Understand the tax implications of your investment. Different investment vehicles may have varying tax consequences. Continuous learning. Stay informed about changes in the market, investment strategies, and economic conditions. Continuous learning is essential for successful long-term investing. Remember that investing always carries risk and there are no guarantees of profit. It is important to tailor your approach to your individual financial situations and goals. Be patient, stay disciplined, and learn from both successes and setbacks in your investment journey.